Hello and welcome to this month's market update for December 2024. My name is Steve Latham and I am the Chief Investment Officer for Bernicke Wealth Management. And this month's theme is going to be around American exceptionalism as it specifically relates to our economy and the markets. And what do I mean by that? Well, when we're looking at how the markets and the economy have fared on a global basis, the United States has really been a step above many other developed countries, not only for the past year, but really going back for the last 5, 10, and even 20 years, depending upon how you measured that exceptionalism. And what we want to dive in today is how we get to that concept and what are we measuring in order to determine why we would want to be in the United States stock markets and exposed to our economy relative to other economies. And one of the first things you need to consider whenever you're talking about markets on a global basis is the currencies with which they use in order to transact in their local economies. So the first slide that I have in front of us here is the performance of the United States dollar relative to other currencies on the global developed market stage. And what we can see since going back to September 26th of this year is that the dollar has strengthened quite considerably relative to other developed nations' currencies. The euro has fallen almost 7% in the last 2 months relative to the United States dollar. And why is that? Well, if you're going to be purchasing more goods and services from the United States because policies are being enacted within our country that suggest that we want to manufacture and produce more goods and services, you need to buy United States dollars in order to purchase those goods and services. So if I'm sitting in Europe and I want to go and purchase something from the United States, I have to sell my euros in order to buy United States dollars and purchase those goods from our country. That is why you have been seeing the United States dollar rally and appreciate relative to other developed nations' currencies. Now, if we take a step back and look at this on a longer time scale, going back 10 years, we can see that the dollar has traded in pretty specific ranges over that period of time. Going back to 2022, we've seen that the dollar has traded within a relatively tight range with the exception of late 2022 when it really spiked above that range. And right now we're at the peak of that range again. Of course, since the election, we've seen the dollar really appreciate relative to those other currencies. But in order to anticipate where we think the dollar is going to go from here, we would need to see further appreciation of the dollar relative to that basket of currencies. So yes, there is this trend currently underway that more countries are buying our dollar in anticipation of needing to purchase more goods and services from us. But we haven't seen an extended breakout of that range for the United States dollar just yet to confirm what we could see over the next 2 to 4 years. Now, moving along, how does that really interpret in local countries relative to the United States from a manufacturing standpoint? Again, if we're thinking that other countries are going to be purchasing more goods and service from our country, that means we're likely going to be manufacturing and making more goods and services. And one of the ways that you can measure that is through something called a Purchasing Managers Index. And that's what we have here in front of us today. The Purchasing Managers Index, or the PMI, is effectively a survey that is given to different companies and manufacturers across each nation and actually ask them, what do the price of goods look like? What do your inventories look like? What is the sentiment around your business? And whenever you get those surveys back, you can put a number to them. And the index that we see here in front of us is something called a diffusion index. And it basically means that if your numbers are above 50, that means things are looking good and they are expanding. And if they fall below 50, that means that things are starting to look a little negative and our outlook is less than optimistic. And so what we can see here with the chart in front of us is in the orange line, the United States PMI index, and in the blue line, the index for the Eurozone. And we can see going back to 2021, they've been relatively in lockstep with one another. That is until around midway through this year, where the United States continued along a positive path, and that index remained above the 54 level range, which indicates a positive expected outlook going forward. But the Eurozone started to fall back. And what that means is, in order to anticipate where those markets are going to go for the Eurozone, the manufacturers are basically telling you that things aren't looking as good as what we had expected them to in years past. With the diffusion index, or the PMI, falling below 50, that tells you that there's some economic hardship potentially on the horizon, at least as far as manufacturers are concerned. So that gets interpreted into our markets by buying and selling individual stocks. And so looking at the stock markets of both the Eurozone and the United States, we can see how the markets have fared as a result of many factors, but one of which is that Purchasing Managers Index. So going back to about the middle of July of 2024, again, we can see that the United States is represented by the S&P 500 in the purple line, stayed in relative lockstep with the Eurozone, which is represented by the orange line, up until around October of this year. And at that time, the two lines diverged quite significantly. Part of this is because, again, the American exceptionalism theme, Trump 2.0, suggesting that more manufacturing is going to be re-domesticated and occurring within the United States. But then also the outlook for the Eurozone became much more negative, not only because of the PMI index, but because of their inability to grow economically across the entire Eurozone bloc. And that has been reflected in the stock markets for both the United States and the Eurozone set of countries. The United States have obviously been doing very well throughout the entire year, really, but certainly so over the last couple months, where the Eurozone has fallen quite significantly since its peak in the middle of October. So the reason why we bring this up is because we do want to keep an eye on not only what's happening in the domestic markets for the United States, but what is happening globally to see if there are opportunities to potentially invest further in the international developed markets. Right now, we've been keeping a relatively cautious outlook on those international markets, and we continue to do so for a variety of reasons. But as it stands today, the expectation is that moving forward, the United States is going to be doing more growth economically, domestically, as opposed to bringing it in from foreign countries. And we're seeing that play out in both stock markets, not only domestically, but internationally as well. If there's any questions on our outlook for the US markets, for international markets, or really anything else in general, please feel free to reach out to us. We're always happy to answer them for you. Thank you.